studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that some key died.
Welcome to the first key concept in corporate investment taxation: deducting expenses against investment income. At the heart of this topic is a simple but very important rule. If a corporation incurs an expense for the purpose of earning investment income, that expense is generally deductible for tax purposes. As shown at the top of the slide, corporations can earn investment income from many different sources, including interest income, dividend income, rental income, capital gains, royalties, and foreign investments. All of these income sources flow into the corporation and ultimately affect the corporate tax return. The question tax preparers should always ask is, was this expense incurred to earn investment income? If the answer is yes, and the amount is reasonable, the expense will often be deductible. Why does this matter? Because deductible expenses reduce taxable income. Lower taxable income means lower corporate tax and improved tax efficiency. Even relatively small deductions can create meaningful tax savings over time. Some of the most common deductible investment expenses include interest paid on investment loans, portfolio management fees, investment advisory fees, custodial fees, accounting fees related to investments, legal fees related to earning investment income, and investment-related bank charges. Notice the relationship illustrated in the center of the slide. An expense must have a clear connection to earning investment income. The stronger that connection, the stronger the deduction. As tax preparers, it is not enough to simply see an expense on a financial statement. We must understand why the expense was incurred and whether it directly relates to generating investment income. The key takeaway from this slide is simple. A corporation can generally deduct reasonable expenses that are incurred to earn investment income, and identifying those expenses is one of the most important steps in reducing corporate taxes legally and efficiently. And remember the tax preparer insight at the bottom of the slide. Always ask, was this expense incurred to earn investment income? That single question forms the foundation of proper investment income tax reporting. In this slide, we focus on one of the most important rules for investment expense deductions, the trace the funds rule. When a corporation borrows money and pays interest on that loan, the key question is not whether a loan exists. The key question is, what was the borrowed money actually used for? At the top of the slide, you can see the typical flow. The corporation borrows money from a bank, invests those funds into income-producing assets, and ultimately earns investment income. When borrowed funds are used for investment purposes, the related interest expense is generally deductible. On the left side of the slide are examples of deductible uses of borrowed money. These include purchasing rental properties, buying stocks, acquiring bonds, investing in mutual funds, or investing in another corporation. In these situations, the borrowed funds are being used to earn investment income, so the interest paid on the loan is usually deductible. On the right side are examples of non-deductible uses. If borrowed funds are used for personal vacations, personal vehicles, personal expenses, or lifestyle spending, the connection to earning investment income disappears. As a result, the interest expense may not be deductible. This distinction is extremely important because the Canada Revenue Agency looks closely at the actual use of borrowed funds. Tax preparers must be able to trace where the money went and demonstrate how it was used. At the bottom of the slide, we have a practical example. A corporation borrows $200,000 and uses those funds to purchase dividend-paying stocks. During the year, The corporation earns $12,000 of dividend income and pays $8,000 of interest on the loan. Because the borrowed money was used to earn investment income, the $8,000 of interest is generally deductible, leaving net income of $4,000 before other adjustments. The key takeaway is simple but powerful. Interest deductibility depends on the actual use of the borrowed funds, not merely on the existence of a loan. Always follow the money. Determine how it was used, and then evaluate whether the interest expense is connected to earning investment income. Mastering this principle will help you correctly identify deductible interest expenses and avoid one of the most common errors in corporate tax preparation. In this slide, we focus on one of the most common areas where new tax preparers make mistakes when dealing with investment income and capital gains. Let's begin with the first concept: brokerage commissions and selling costs. Many beginners assume that when a corporation pays a brokerage commission to sell an investment, that commission should simply be deducted as an expense. However, that's usually incorrect. Instead, brokerage commissions, selling fees, and similar costs are normally included directly in the capital gain calculation. Rather than being deducted separately, they reduce the amount of the capital gain itself. This brings us to the capital gain formula shown in the center of the slide. To calculate a capital gain, start with the sale proceeds, subtract the adjusted cost base, or ACB, and then subtract any selling costs or outlays and expenses. The result is the capital gain. In the example shown, shares are sold for $100,000. The adjusted cost base is $70,000, and the brokerage commission is $2,000. After subtracting both the ACB and the commission, the resulting capital gain is $28,000. Notice that the commission was not deducted as a separate expense. Instead, it reduced the capital gain directly. On the right side of the slide, we see how investment information flows through the corporate tax process. Everything begins with investment activity. Those transactions are recorded in the accounting records, summarized in the financial statements, reported through GFI reporting, transferred to the T2 corporate tax return, and ultimately affect taxable income. Understanding this flow is important because corporate tax preparation starts with proper bookkeeping and financial reporting. At the bottom left, you'll find a practical checklist that every tax preparer should review before claiming investment-related expenses. Ask yourself, was the expense incurred to earn investment income? Is documentation available? Is the amount reasonable? Should it be treated as a current expense, or should it reduce a capital gain instead? And does the accounting treatment match the tax treatment? The red flag section highlights situations that often attract CRA scrutiny. These include personal expenses charged through the corporation, unclear use of borrowed funds, excessive management fees, missing documentation, shareholder benefits disguised as expenses, and duplicate deductions. Before filing any corporate return, it is helpful to think like an auditor. If the CRA requested support for a deduction tomorrow, would you be able to justify it? The key takeaway from this slide is the distinction shown at the bottom. Every cost should be classified as either a current expense deductible against income or a selling cost that reduces a capital gain. Making this distinction correctly helps prevent some of the most common corporate tax preparation errors and leads to more accurate, defensible tax reporting.